So this question, Angel, is from the 2013 December exam, so I'm not convinced that it's going to be a high-risk topic for December 2014, but who knows. I've simply set out a single page for operating cash flows. I know from experience that operating cash flows tend to be quite a lot, and half a page for investing and financing. And then the rest of our time is going to be T account fun and games. Hooray indeed. And broadly, most of the main headings in the statement of financial position are going to form the basis of our T accounts. So we've got PPE and we've got an opening balance of 465 and a closing balance of 475. Next we've got Goodwill. Don't tend to be that many adjustments for Goodwill. So working number 2. Opening balance 120, closing 105. Then we come to our intangibles. Opening 240, closing 150. Associate, didn't have one at the start of the year. So our brought down was 0. Our carry down was 80. Financial assets. We could have one for financial assets. All that I would say is that I've referenced the financial assets to note 7, which actually has got a full breakdown of the movements. So yeah, it's up to you. I probably would say wouldn't bother. Sometimes these things are a little bit of a gamble. So I'll just put an outstanding. Next we come to inventories. Inventories have gone down, and inventories are part of our operating cash flows. We start off, if you recall, with profit before tax. Then I'd put about a third of the halfway down movement in working capital. Now you don't have to be this precise in the exam. The examiners, the examining team are fairly relaxed. They know you're under stresses and strains. So as far as inventories are concerned, on the face of it, they've gone down by 35, but we know we've got the acquisition of a subsidiary to deal with later on in the question. Trade receivables. They've gone down by 55. Then we come to cash and cash equivalents. Those are our closing balance in our cash flow statement. We've got an opening balance of 355 and a closing balance of 465. So therefore, cash and cash equivalents must have increased by 110 in the year. Slot that number in. That's going to be the total of your operating, investing and financing cash flows. And my advice is just assume that what you've done adds up to 110. Never add it up. Never add it up. You get no more marks for it. Now, next we come to equity. My advice is I always look to see, do we have a statement of changes in equity? The answer here is yes, in which case delay. Don't deal with anything and use your statement of changes in equity to actually crank out the numbers that we're going to need for our cash flow statement. We've got long-term borrowings, so that's a financing cash flow. It's not referenced to anything. I'll have been through and referenced everything. So it looks like that's going to be minus 31. And then we've got tax. Now the secret with tax is to combine current and deferred tax together. Now this is a liability. We've got an opening liability as far as deferred tax is concerned, 31. And 35. Then we've got our retirement benefit liability. But again, I put a little star by that. If you look at note 3, they've laid out all of the movements. So we don't need to use a T account. I mean, you can do if you so wish, but why not just use the information from the question itself? Trade payables is part of working capital. Go up to movements in working capital. Trade payables are down by 206, and then we've got current tax. We've set up a tax T account. So for current tax, opening balance 138, closing balance 49. Okay. So that's dealt with the first page. That's 1 page out of 4 dealt with as far as this question is concerned. So we're a quarter of the way through in only 7 minutes. Next, and this is why this question is particularly evil. The first thing I always target is the profit before tax figure as the start point in my cash flow statement. And we've got a profit before tax figure of 188. But that's a draft profit before tax, okay? So, because we know that there's going to be the company's made some errors in its accounting. Now, we don't know that at the time, so it's a bit mean of the examiner. But the examiner's one mean dude at times. We then look above that line to see, are there any non-cash flows that we can immediately see? And the first thing that I see is the share of profit of the associate, equity accounted investees. Why they call it that, I'm simply going to say share of associate. And remember, whatever we do in our statement of profit and loss, we do the opposite in our cash flow. So I'm going to deduct 12, and because that relates to the associate, I'm going to pop down to my associate T account, credit statement of profit and loss, debit associate T account with 12. Statement of profit and loss, profit share. We also have finance costs, and convention tells us that we should adjust our finance costs. Now, I've referenced finance costs to one of the notes. So what I'm going to do here is to say finance costs. I think I'm going to adjust that by 11, but because I've referenced it to one of the notes, that might not be the case. And I'm also going to put finance. Now, you've got a choice as to what you do with finance costs. You can show them as a financing cash flow, or you can put them at the bottom of operating cash flows. So I'm going to say here, finance costs paid 11. Now again, because I've referenced it to one of the notes, it might need adjusting. That's why I'm not going to put in a final figure just yet. Moving further up the statement of profit and loss, I can't see anything which directly suggests it's a non-cash flow, so I'm going to leave that. I'm now going to move my way down the statement of profit or loss, and I come to the income tax expense, debit statement of profit and loss, credit tax T account. And then we've got the split between the owner and the NCI. Well, all of that's in my statement of changes in equity. So I'm going to skip that. We then come to other comprehensive income, items that will not be reclassified to profit and loss. Financial assets, we've revalued up by 4, but that's already in my financial assets note. So therefore, we don't need to deal with that. We've got revaluation of PPE. So I'm going to go credit revaluation surplus, debit PPE, revaluation 8. Actuarial losses on defined benefit plan. Well, we've got a note in respect of the defined benefit plan, so I'm going to deal with that when I get to the note. And then we've got the tax on the items not reclassified, and that's a loss of 3. So debit OCI, credit tax 3. And I've no idea what the little asterisk means relating to financial assets, and I'm not particularly worried either. Total comprehensive income allocated to the parent and the NCI, that will be dealt with in statement of changes in equity. So let's now go to our statement of changes in equity, and I'm going to deal with this column by column. The first thing that we see is shares issued. And I'm going to put this in. I know that there's been an acquisition of a subsidiary in the year, so I don't know whether we've issued shares at this stage or not. So I'm going to put that in as a bracketed working. Retained earnings, we've got our profit for the year, but we've also got our dividends for the year. Dividends paid are a financing cash flow. Dividend paid by parent 10. Our financial assets reserve, we've got an adjustment in that, but I'm going to deal with that when we get to our financial assets note. We've got a revaluation reserve, and we've dealt with revaluation in the year, so don't need to worry about that. And then we come to the non-controlling interest, and it says in the non-controlling interest we've got dividends paid to the NCI of 6. So dividend paid to NCI 6. So there's not a lot taking place here, but we'll have picked up 6 or 7 marks for bare minimum just for putting your opening and closing balances in. So that's page 2 dealt with. Page 3, Angel decided to renovate a building which had a 0 book value at the 1st of December at the start of the year. As a result, 3 million was spent on its renovation. On the 30th of November, at the end of the year, we received a cash grant of 2 million. The grant related equally to job creation and renovation. Now, there's an awful lot taking place here. I'm going to take what I refer to as the 3-column approach to sorting out the mess. The 3-column approach, this is going to be for the building. And I say, well, what should the correct entry have been? what was the actual entry made by the company, because it's put through some nonsense. And this gives us our adjustment. So we revalued, we've renovated the building. 3 million was spent on the renovation, and we received a cash grant. The only elements recorded in the financial statements were a charge to revenue for the refurbishment of the building. So what we've actually done, we've gone credit cash 3, and we've debited revenue, which is statement of profit and loss 3. What should we have done? Well, we should have gone credit cash 3. We're told that the building was revalued at the 30th of November X3 at 7 million. So we should have credited OCI 4 million, and we should have debited PPE 7 million. So the adjustment that I'm going to make is I'm going to credit revenue with 3. I'm going to credit OCI with 4. And I'm going to debit PPE with 7. Now, what this means is that we need to increase our closing balance. So I'm going to now scrub out that figure of 475. PPE now needs to be 7 higher. And the other thing that we need to do is that we need to credit revenue. So revenue flows through into profit before tax. So I need to increase revenue by 3 and therefore increase profit by 3. Now, this is all the nerdy stuff that we don't expect, or I wouldn't expect students to get right in the exam, so don't get stressed about it. Okay, it's a non-issue. Focus on your basics. What else? We've got something in relation to a grant. And let's think about what we should have done and what has. We've received a cash grant of 2 million. So the correct entry would be to go debit cash 2 million. This was to cover some of the refurbishment cost and the creation of new jobs. The grant related equally to both job creation and renovation. Angel treats grant income on capital-based projects as deferred income. So what we should have done is that we should have credited the statement of profit and loss with half, because half of the money was for job creation. And we should have credited deferred income with 1 million as well, because that's what we've been told to do. So we should be creating a deferred income liability in respect of the PPE. What have we done? We went debit cash 2 and we credited it to PPE 2. Okay, it's been credited to additions of property, plant and equipment. So in order to clear up the mess, we need to debit PPE 2, credit the statement of profit and loss 1, and credit deferred income 1. So that credit to the statement of profit and loss is going to increase profits by 1. So what we're going to do here is we're going to increase profits by, that's working 6, yeah, sorry. That's working 6 and working 6. So that's our first item. Secondly, on the 1st of December X2, we acquired all of the share capital of Sweetie for 30 million. And there's no evidence of us doing anything other than paying cash. So I can go directly to the investing section of the cash flow statement. Payment to acquire subsidiary, 30 million going out of the business. We've then got the fair values and some nonsense about tax to deal with. We'll deal with each item in due course. We're given the fair values of the assets of Sweetie, and it says the fair values in the table have been reflected in the year-end balances of Angel. So for the subsidiary, it's got PPE of 14. So we add that to PPE. We've got inventories of 6. Inventories are working capital, so I'm going to subtract that figure of 6. Nothing else is referenced to inventories. Asset down equals cash up by 41. For receivables, it's 3. So now I've got minus 58. Asset down equals cash up by 58. We then have cash. What do we do with the cash? Remember, you net off the cash received from the cash paid to acquire the subsidiary. So I'm going to go to my investing cash flows. Cash of subsidiary at acquisition 2. So our net cost of acquiring the subsidiary, which is a figure we should show, is 28. So there's stuff that you can do and there's stuff that you can't do in the question, and all the time I'm just trying to pick up the things which I feel confident about. We've then got the acquisition of the subsidiaries pension benefits. We'll deal with that in note 3. And we've got a deferred tax liability of 0.6. So subsidiary 0.6. Now, if we're feeling brave, we can now calculate goodwill. So, working number 7. Goodwill of subsidiary. The consideration is 30. It's a 100% owned subsidiary, so I'm just going to stick in the NCI of 0 just to remind us. Less the net assets at fair value, and the fair value of those net assets is 20. So if you'd done that and you calculated goodwill of 10, you'd have picked up a couple of marks. But there was a little twist in the tail in relation to deferred tax. So deferred tax on acquisition. And what you do with deferred tax, you take the carrying amount of the assets, and the carrying amount of the assets was 20. You take away your tax base, which is 15. We're dealing with assets, So this is a taxable temporary difference of 5. So we've got deferred tax charged at 30% on that, which gives us a figure of 1.5. So that's a standard deferred tax adjustment. So there would have been a couple of marks going for that, and I would hope that, if you study deferred tax, what you do is compare carrying amount to tax base. So even if you just did that and did nothing more, you'd have picked up a couple of marks. What we then say is that we have to take away, because that's going to be a deferred tax liability. So the net assets at fair value are in fact 18.5. Now that's the nerdy bit, but don't get hung up about those bits. If you'd calculated goodwill of 10 and you'd had a go at calculating the deferred tax, you would have picked up plenty of marks. So this gives us a goodwill figure of 11.5, and we've increased our tax liability by 1.5. So I'm going to put both of those through. Goodwill, acquisition of subsidiary, that's from working number 8, is 11.5. So that goes into our goodwill calculation. We must also reflect the deferred tax in our tax T account. Subsidiary deferred tax 1.5 from working number 9. Now, some people got that, some people didn't. There's a lot going on. So that's note 2 dealt with. Note 3, the examiner is testing us on our knowledge of pensions. So we've got our opening and closing net obligations. And what we do is we say, is there a non-cash expense? Well, the figure in the statement of profit and loss is the net interest cost plus the service cost. So I'm going to go up here and say pension expense. What is the pension expense? It's 3 for net interest plus the service cost of 8. We're given the contributions to the plan of 9. That's the cash flow. So I'm going to go down, and we tend to show the pensions paid at the bottom of the operational section. So pension contributions is the cash flow by the company, and that is 9. It says the benefits paid by the trustees of the plan were 6 million. Well, that's completely irrelevant because that's paid by the pension fund. That is not paid by the employer. That's a sneaky piece of additional information. Angel had included the obligation assumed on the purchase of Sweetie in the current service cost. Well, it shouldn't have done that. So what I'm going to have to do, and again this is a nerd point which I wouldn't expect people to spot, is from my pension expense I'm going to reduce that by 1. So therefore the pension expense is 10, and because that relates to the pension, I'm going to add 1 back to profit. Because I've just reduced the pension expense by 1, that increases profits by 1, doesn't it? Then we've got note 4 in relation to PPE. PPE, note opening balance 465. We've got the gains on the property revaluation. We've got the additions, but we don't know how much of those are for cash. We've got some disposals. So let's go to our T account. Disposals are 49. Depreciation is 29. Depreciation is a non-cash expense. So I'm going to take that depreciation figure of 29 and add that back to profit. It then says Angel has constructed a machine which is a qualifying asset under IAS 23 and has paid construction costs of 4 million. This amount has been charged to other expenses. Well, they should have capitalised that, shouldn't they? So let's work out what's happening here in respect of borrowing costs. Correct. Actual an adjustment. So what should we have done? We should have gone debit PPE 4, credit cash 4. What have we done? We've gone debit profit and loss 4, credit cash 4. So to correct that, what we need to do is to debit PPE 4 and credit profit and loss 4. So I'm going to go up here and I'm going to add a further 4 onto profit. And it also says Angel paid 11 million in interest in the year, which includes 1 million of interest which Angel wishes to capitalise under IAS 23. So we also should have gone debit PPE 1, credit cash 1. We've gone debit profit and loss interest 1, credit cash 1. Therefore, I'm going to credit the profit and loss 1 and debit PPE 1. So my finance costs paid were in fact 10 million, because we've capitalised one of those, and the finance costs up here we take off 1 million. So we're going to add back finance costs of 10. The disposal proceeds were 63. So we've got a sale of assets a sale of PPE of 63. The gain on disposal is included in admin expenses. So gain on disposal. We sold them for 63. They cost us 49. That's a figure of 14. That's the gain on disposal. If it's a gain in the income statement, we show that as a negative here. Note 5. Angel purchased 30% of an associate for cash, but they've not told us what the cash is. The net assets of the associate at the date of acquisition were 280. The associate made a profit of 40 million at the date of acquisition. So, if we go to our associate account, we have a dividend being received, which is going to be 30% of the 10 million dividend, which is a figure of 3 million. So I'm crediting my associate account. That's cash being received. Go to investing cash flows, divvy from associate 3. We don't know how much the cost is. An impairment test carried out at the 30th of November X3 showed that goodwill and other intangibles were impaired. So this is giving me a heads up. Let's go to the goodwill account. 131.5 compared to 131.5. So I'm going to put a beta to denote a balancing figure. So we've got an impairment of 26.5. That is a non-cash expense, so we add that back to profit. Goodwill impaired, 26.5. That's come from working number 2. And we've got intangibles impaired. Okay, by giving us this note, the examiner is saying there's no more work to do on intangibles. It's simply the balancing figure of 90. That's our impairment. $90 from working 3. Note 7. We've got information in relation to the financial assets. We've got our opening balances, we've got some sales, we've got some purchases. So we can go to investing cash. We don't need a T account because the examiner's given us all the information that we'd show in the T account. Payment to acquire financial assets, 57. We've got our revaluation from OCI, that's fine, that's been dealt with. It then says the sale proceeds were 40 million. So, sale of financial assets, 40 million coming in, like so. Profit on the sale is included in other income. So we go up here. Gain on financial asset sale is 14. Because it's a gain, we show it as a deduction. And the financial assets include a mixture of financial assets measured at fair value and investments in equity instruments. All the financial assets at fair value through profit and loss were sold, so there's nothing further to adjust. The finance cash costs were all paid in cash in the period. So we've got to prepare a statement of cash flows. What we can now do is we can go to our T accounts. I'm just going to change colour, and I'm going to tidy up my T accounts. Just a quick check. The trade payables of the subsidiary, I managed to skip those. I shouldn't have skipped those. So trade payables have gone down by 210. So that 4 is the trade payables of the subsidiary at the date of acquisition. Liability down equals cash down. Let's now take a look at our T accounts. And for PPE, this is where it's impossible. I should have added in the grant. I should have added in the capitalised interest. I wouldn't expect anybody on the planet to get this right. We get a figure of 485. And that gives us a balancing figure of 76, which is PPE additions. Now, if you'd put in the revaluation, the subsidiary, the disposals and depreciation, you would have picked up the marks. So yeah, there would have been three marks going perhaps for PPE. Getting that closing balance, don't expect anybody to get that right. You'd picked up 2, even if your closing figure was incorrect. So purchase of PPE from working number 1 is 76. Goodwill we've dealt with, intangibles we've dealt with, associates, balancing figure of 71. We know that we bought an associate during the year, so the 71, which is our balancing figure, payment for associate 71, that's cash going out of the business. 71, payment for associate from working number 4. Next we've got tax. We've got credits in respect of tax. I just want to check this number. Hold on a sec. Right, I've just spotted one slight error. The tax of the subsidiary of 0.6 wasn't the fair value. We should be, of course, putting in the fair values. That was the carrying value. So therefore, I shouldn't have put in that figure 0.6. Apologies for that. So we can now move this up a little bit. So it's only the deferred tax of 1.5 from working number 9 that goes in. That gives me credits of 219.5. Credits must equal debits. How do we get this to balance? We stick in a balancing figure. 135.5 is our balancing figure. Cash tax paid. And again, not many people would get the correct answer, but if you do your basics, you'll pick up the 2s out of 3s and the 3s out of 4s that are available. So the tax paid is 135.5. And this again tends to appear at the bottom of our operating section, so tax paid 135.5. Finance cost to pay is, of course, the cash flow going out. That has come from working number 5. So we've dealt with our T accounts, we've put through our journals. This is the bit you don't do in the exam. Okay, so we're going to restate our profit figure. So our profit figure gets restated to 197, and if we add all of this up, which is a ridiculously long exercise, total operating cash flow, that comes to 57. If we do our investing cash flows, total investing cash flow, that comes to minus 125. No adjustment to the movement in borrowing, so that's minus 31. The shares issued were 225. So our total financing cash flow is 178 positive. So now I add up those figures. 178 minus 125 plus 57, that adds up to 110, and we balance.